Hello and welcome to Lazard Insight Series. I'm Jay Jacob, Lead Portfolio Manager in Lazard's multi-asset team. I'm joined today by Steve Mara and Ariana Kusainova, both portfolio managers on that multi-asset team. Steve and Ariana manage portfolios that target specific levels of volatility and have done extensive research and written white papers on this subject, which you can find at lazard.com. Today, they will discuss the extreme spike in volatility in response to the COVID-19 pandemic. Steve will first discuss this dramatic spike and why volatility is so important to financial markets. He will also describe what it means to take a volatility-targeted approach. Ariana will then focus on asset allocation and diversification, with a particular focus on asset class correlations over time. Ariana will compare today's crisis to the 2008 global financial crisis from a volatility perspective. And at the end of the presentation, we'll touch on a few topical questions. First, I'll ask about the implications of having such a sudden shift in the prevailing levels of volatility. We'll then look at how our clients may want to approach asset allocation as it pertains to their portfolios during this crisis. And finally, we'll take a look at what investors can expect from a volatility perspective over the next 6 to 12 months. So with that, let's get started. I'll turn it over to you, Steve.
Thanks, Jay. Volatility in markets has risen pretty dramatically in recent weeks as a result of COVID-19. This volatility has touched all corners of the market, from equities to currencies to credit and interest rate markets. The VIX index, which is a measure of implied volatility on the S&P 500, reached 82.7% on March 16th, the highest closing level ever recorded. Why is volatility important for financial markets? Uncertainty is inherent in every financial model. There are many different factors that drive uncertainty in markets. Changing fundamentals, the manner in which the markets discount potential future states of the economy, even human psychology has an impact on the degree of market uncertainty. Clearly, the uncontrolled spread of a poorly understood deadly virus has thrust more uncertainty into the global economy than any event in recent history. And the most widely accepted gauge of uncertainty in markets is volatility. Over the years, as options and derivative markets have developed and evolved, volatility has effectively become the expected price of uncertainty in markets. The cost of hedging goes up when uncertainty and volatility is higher. Volatility is at the heart of every investment decision. A strategic asset allocation decision is ultimately governed by the trade-off between risk and reward. Reward in the form of an expected return, and risk being the degree of uncertainty surrounding that expected return, or volatility. One approach to asset allocation uses a static weight between equity and fixed income. Take, for example, a 60-40 equity fixed income allocation. This weight is typically driven by an investor's risk tolerance and is determined by picking a spot on an efficient frontier that coincides with a level of volatility that is commensurate with that investor's risk tolerance and investment goals. The efficient frontier on this slide depicts the return and volatility of a 100% bond portfolio on the left, a 100% equity portfolio on the right, and everything in between. This frontier uses the realized return and volatility data for U.S. equities and bonds from 1980 up to February 2020. And this is how an efficient frontier typically looks, rising up and to the right, meaning that the more risk that is added, measured by volatility, the higher the expected return as compensation for that additional risk. It shows that equities have returned an additional 3.9% per year, and that the cost of this 3.9% of added return has been an additional 10% in annualized volatility. Now, a static allocation between equities and fixed income over that 40-year period would have made sense if the risk-reward trade-off were consistent over that period. However, the next slide suggests it wasn't. This slide shows efficient frontiers broken down into different time periods using the same U.S. equity and bond returns within that same 40-year span. You can see that the risk-reward profile of equities and fixed income were actually quite different at different times during those 40 years. During the 90s, for example, equities added almost 10% annualized return for a roughly 10% increase in volatility. Whereas in the first decade of the 2000s, you can see the gray line actually dropping down and to the right, meaning that equities actually detracted almost 8% annualized for the 13% they added in volatility. This slide shows COVID-19's impact on the efficient frontier. This frontier is only looking at the last 2.5 months of returns data. You can see that an equity allocation actually cost you 12% in returns over the period while adding about 57% of annualized volatility. So a relatively short time frame, but you were clearly not getting paid to take risk in this environment. This lack of uniformity of this risk-return profile over the years indicates that opportunities existed during this 40-year span to add considerable value, both from return enhancement as well as risk reduction from an asset allocation process that was more active. This argues against having a fixed asset allocation and moving towards a more active asset allocation approach. And targeting volatility can be quite a useful asset allocation tool. While past returns themselves don't help to predict future returns, the magnitude of past returns does, in fact, have some explanatory power on the magnitude of future returns. Large returns tend to be followed by large returns, while small returns tend to be followed by small returns. As a result of this relationship, past volatility actually has a reasonable amount of explanatory power over future volatility. It is this persistence of volatility that makes it considerably easier to predict than asset returns themselves. This slide compares the relationship between past and future returns and past and future volatility. In the first chart, you can see that there is no relationship between past returns, y-axis, and future returns plotted on the x-axis. The r-squared is 0, indicating that there is no statistical relationship. So, as an asset allocator, if you are basing your asset allocation decision solely on the forecast of future returns, past returns will provide no help to you. The second chart plots past volatility on the y-axis against the next month's volatility on the x-axis. As you can see, a positive relationship does exist. The r-squared here is 0.38, indicating that there is a statistically significant relationship between past volatility and future volatility. In other words, when past volatility is high, future volatility is likely to also be high, and vice versa. When volatility is low, it tends to persist for a period of time. This relationship is known as the latency of volatility, and this latency makes it significantly more forecastable than asset returns themselves. So if instead of basing your asset allocation decisions solely on past returns, you incorporate past and present volatility into your asset allocation decision-making process, you are using a factor that actually has some predictive power over future outcomes. The next characteristic that makes volatility prediction a powerful tool in asset allocation is the negative correlation between volatility and equity returns. The mathematical calculation of volatility is indifferent to the direction of the market. However, volatility rises when the market falls, and volatility tends to fall when the market rises. It has been theorized that this relationship is fundamental in nature and is due to what is called the leverage effect. The leverage effect posits that as stock prices fall, companies become more leveraged as the value of their debt rises relative to the value of their equity. As a result, the stock price becomes more volatile. So ultimately, a targeted volatility approach to asset allocation aims to take advantage of these two market relationships, the negative correlation between volatility and return, as well as the persistence of that volatility, or the tendency of periods of high and low volatility to cluster together for sustained periods of time. Targeting a particular level of volatility takes advantage of these relationships to smooth the return profile and provide a degree of downside protection in a rising volatility environment. In its simplest form, this is achieved by selling equities while volatility is rising and buying equities while volatility is falling to maintain a particular level of volatility throughout different market environments. So, as a risk calibration feature, volatility targeting is a systematic approach to dampening volatility, enhancing and smoothing returns, and can be quite a valuable complement to an asset allocation framework.
Thank you, Steve. I'll now turn it over to Ariana Kusainova, who will talk specifically about some of the historical and current diversification dynamics as part of the portfolio construction process and some of the changes maybe to the current market stress.
Thank you. As many of you are aware, diversification is one of the most critical components in the successful construction of a multi-asset portfolio. The key principle is that combining uncorrelated asset classes reduces the portfolio's volatility and improves the risk-return trade-off. The portfolio's diversification potential, however, is highly conditional on uncorrelated nature of investments. When that relationship is broken, the ability to mitigate volatility becomes impaired. As history shows, and the current market environment confirms, correlations among asset classes are not stable over time and can change dramatically. For example, since 1976, correlation of U.S. large-cap equities and U.S. debt has been as low as negative 0.47 and as high as positive 0.64. Over a similar time frame, U.S. large-cap equities and international large-cap equities went through intervals when they were virtually uncorrelated and almost perfectly correlated. In the times of market stress, correlations tend to increase even among less correlated asset classes. If we zoom out and measure correlations from the beginning to the end of any major crisis, even though they're broadly elevated, there's still scope for diversification and protection coming from allocation to less risky assets. You can see that on this slide that shows rolling 1-year volatility decomposition for 50-50 equity and fixed income blend, where the diversification benefit is represented by the green area. Even in times of highest financial instability, less correlated nature of debt and equity returns allowed for some drawdown protection. That said, back in March, we went through the fastest S&P 500 bear market correction in history. The market fell over 20% in 15 days from its peak on February 21st. For comparison, it took 191 days for the markets to get into a bear territory during the global financial crisis of 2008. As we dissect the day-to-day dynamics of the market's free fall at the time, in this slide we are showing the daily index returns for the month-long period starting from February 24th for different stock markets, government bonds, and a range of commodities and alternatives, 15 different asset classes in all. As you can see, from the onset of the volatility shock through March 29th, equities and bonds maintained their negative correlation. As stock prices fell, bonds offered capital protection and helped offset losses on the equity side. However, from March 10th, as the COVID-19 and oil shock unforced, the natural and expected market reactions to economic events morphed into an internal market crisis. Volatility begat volatility. From that point, we can see that a lot of asset classes were moving in the same direction, with the most striking dynamic on March 12th, when 15 out of 15 asset classes in this example were experiencing negative returns. When the relationship between defensive versus risk-on assets got broken, only portfolios structurally designed to handle those stresses could truly defend during those days. It is also worth mentioning that March sell-off environment presented additional challenges for multi-asset managers in the form of cross-asset volatility increase. Typically, equity volatility is the primary culprit of volatility drivers within a multi-asset portfolio. However, in the times of substantial market stress, currency, credit, and interest rate volatility pick up as well, becoming additional significant sources of price fluctuations. As you can see on this slide, an implied volatility of S&P 500 stocks increased 5 times back in March, while implied volatility of 10-year treasuries increased 3 times, and as Steve mentioned, even surpassed on some days the level seen during the global financial crisis. A distinguishing feature of this crisis was that it did not originate through the typical rhythms of economic cycle, where the signs for a downturn could have been perceived by the market early on. Instead, the catastrophic global health crisis unraveled with little warning, and the unprecedented suddenness of the events was met with a rapid sequence of massive policy responses to provide liquidity and support market functioning, which in turn transmitted its effects through the currency and rate channels, creating the additional sources of volatility that investors had to grapple with.
So, question, Steve, if I may, what are the implications of having this sudden shift in prevailing levels of volatility?
The suddenness of the shift is certainly a challenge from an asset allocation perspective. Following the volatility around the US-China trade deal, we had a period of extremely low volatility. There was a period of over 4 months where the VIX index hovered between 9 and 16. Then, beginning in late February, when Italy began reporting growing numbers of COVID-19 infections, the VIX began to rise dramatically, and within about 15 trading days, it went from 15 to its highest closing level ever at 82.7. For strategies that target volatility to smooth the pattern of return for investors, their equity risk budget was basically cut to 1/6 of its previous level. So if you think about it from the perspective of a balanced portfolio with equities and bonds, if you were trying to target a 10% level of absolute volatility, you needed about a 90% allocation to equities to get there prior to this crisis in February. Within 15 trading days, a 15% allocation to equities would get you to 10% volatility. So maintaining the same level of volatility required a 75% reduction in your equity allocation. As Ariana discussed, another factor that's been complicating the traditional asset allocation process has been the rise in correlations between equities and global bonds, with the transmission mechanism of these higher correlations being primarily through the currency and credit markets. In addition to the preceding period before this crisis being one of exceedingly low equity volatility, it was also a period where equities and bonds were moving in opposite directions. This negative correlation enabled asset allocators to take larger risks in equities due to the cushion that bonds were providing. This changed in early March as the credit and currency markets pushed the global equity bond correlations significantly higher. In addition to the dramatic increase in equity volatility, you saw equity bond correlations move from negative 0.7 in late January, so moving in opposite directions, to positive 0.6, moving in the same direction. If you look at higher frequency data, the correlations have since dropped, but this is only after the US Federal Reserve stepped in to shore up the credit markets. The currency markets, on the other hand, are likely to remain a source of positive correlation going forward as the US dollar continues to be a safe haven asset.
And Ariana, how does that impact your view on asset allocation itself? I mean, a vol targeting strategy works by dynamically shifting stocks, bonds, cash, other asset classes, diversifiers. So how have you been thinking about that given what we've been seeing in recent weeks? And what would you recommend to our clients and partners in terms of their own asset allocations when they're faced with difficult decisions like these?
Sure, Jay. When the market conditions are changing so dramatically and so rapidly, it is important to be able to intervene promptly. But a number of factors occurring simultaneously make it exceptionally difficult to do that. So you have toxic combination of volatility spiking across asset classes, correlations going up, and the cost of putting protection increasing substantially. This is exactly the time when the toolkit for diversification and volatility reduction in the portfolio becomes limited. One way to better immunize the portfolio from market drawdowns is to integrate permanent hedges in its design, which could help keep correlations in check. If the portfolio is not eligible for shorting, it is important to have tactical flexibility to increase cash, which ends up being one of the most uncorrelated assets within the long-only construct when volatility spikes. Another important point is to have clarity on what the potential blind spots your portfolio may have due to the hidden factor overlaps. As different asset classes can share common exposures, a multi-asset portfolio should be analyzed through factor decomposition techniques. This allows to account for and minimize overlapping exposures among asset classes, which ultimately helps to better manage aggregate portfolio risk, as well as to avoid a false perception that the portfolio has been adequately diversified when in reality it wasn't. If anything, The most recent events showed that a robust risk discipline is especially valuable in times of panic and irrational market behavior, as it can minimize emotion-driven trading and being whipsawed by sharp market moves.
Thank you. And maybe one last one. We have in the multi-asset team a 6 to 12 month forecast and spend much of our time debating and articulating views as it pertains to the economy, to valuation, liquidity, sentiment. Maybe you could spend a few minutes talking about what this means from a volatility standpoint.
One of the biggest enemies of markets is uncertainty. The economic dislocation that we are experiencing right now has no real timeline. Some regions, countries, and localities are beginning to slowly reopen their economies, but there's no real end date for the severe pullback in economic activity. So we are dealing with an extremely uncertain period of time where most economic models and earnings projections have huge error terms around them. And this is what the market has been and will continue to be digesting over the weeks and months ahead. The best estimate we can come up with for how long the market expects this to last is from the options market. We've been talking about the VIX index as a measure of market volatility. This is focused on current volatility expectations. We can also look at the VIX futures market, which looks at the market's expectation for volatility going forward. Both the VIX and realized volatility has come down significantly over recent weeks. The VIX futures market largely anticipated this. The futures market is now anticipating volatility to increase up to the US presidential election in November, after which it is expected to drop further. I believe that whether or not the options market is correctly predicting future volatility will be dependent upon the antidote to uncertainty, which is data. We've gotten some pretty horrendous economic activity data over the past weeks. This was not exactly a surprise. A lot of this was already priced into markets before the data was released. We've also gotten more data about the relative success and failure of some of the various balancing acts that many governments have been performing between degree of economic shutdown and blunting the impact on the local healthcare systems. So I think this economic data, along with the data we've seen about how these measures have affected the spread of the virus, have allowed investors to more accurately assign probabilities to different economic scenarios. And as this has happened, price discovery has become more orderly and market volatility has declined as a result. The next big uncertainty out there is the impact of loosening some of these economic shutdowns on a potential resurgence in infection rates. We will be seeing more of this data in the coming weeks, and this will provide, at least incrementally, the first real sense of how long this economic upheaval is likely to last.
Thank you, Steve, and thank you, listener, for your time. Please feel free to reach out to your Lazard representative if you have any further questions.